been learning about value investing, finance, just regular investment for a while now, but you don't know where to go next. You're getting confused about the vast amount of information on the internet. You don't want to waste your time on crap information. You want good information and reliable information. In this series of videos on value investing and finance education, you will find those answers to those questions and much more. My name is Jason Rivera. Welcome to Value Investing and Finance Education. Hey, Jason here. In today's episode of how we quantify and evaluate qualitative side investment, today I need to tell you before we get into the details of that, I need to tell you what my definition of quality is, because that's a very, frankly, subjective term. Last week we did a bit of an intro. Sorry, I was looking at my notes. We did a bit of an intro on the qualitative side of value investing. That video will be linked below this one. So if you want to get caught up on that, kind of my overview thoughts on qualitative side of investing, make sure to click that link below. Today, talk about quality and how I determine it, frankly, my definition of quality. So if you've ever read or listened to the book Zen and the Art of Motorcycle Maintenance, highly recommend it, first of all. But what's his name? Cannot think of his name right now. Robert something. It's going to drive me nuts. Anyways, he was a college professor who essentially drove himself crazy trying to figure out quality, what quality meant. Because, again, it's subjective. Trying to figure out what his definition of quality was, how he defined it, all that kind of stuff. Fantastic philosophical book. Will make you think enormously. So I highly recommend that book. But frankly, the reason I want to talk about this today is because my definition of quality will be different from your definition. I want to let you know that right off the bat. It doesn't matter if we've studied the same stuff. We are completely different people. We have different biases. We have different experiences in the past. Our definition of quality and our risk profiles are different. That's a big one as well. Our definitions of quality will vary widely, even amongst deep value investors. So my definition will be different from yours. You need to figure out what your definition of quality is. But I'm making this video to kind of give you some guidelines on what I view as quality. So I invest in three types of investments: Benjamin Graham, end cap stocks, net nets, whatever you want to call them, cigar butts, typically terrible operating businesses, selling far below their book value and the value of their assets. Warren Buffett type compounders, which is quality investments, and again, we'll talk about that in a second, and special situations, going private transactions, spin-offs, asset sales, liquidations, all that kind of stuff. It's pretty much impossible to find Benjamin Graham and cap stocks of any kind of decent opportunity. Most of the ones you find now are just absolutely terrible businesses that are either going to go bankrupt or going to get bought out or are burning so much cash it's not even worth it to buy them. Special situations, I don't invest in those much anymore. I used to more. Frankly, I don't as much anymore because I concentrate on Warren Buffett compounders most of the time now. Benjamin Graham and cap stocks, special situations, I still will occasionally invest in those, but most of the time I look for Warren Buffett type compounders, or what I determine as Warren Buffett type compounders. So what is that? Or what are those? Companies with potentially long-term sustained competitive advantages. If they do have these, better. Most of the companies I look at are smaller companies, so they don't have this, but they have the opportunity in most cases to achieve that if they continue to grow and expand their market. high operating profits, or high operating margins, sorry, above 10% on a consistent basis, high ROICs above 10% on a consistent basis over long term, high free cash flow to sales margins above 5% on a consistent basis, high ROCE, return on capital employed, above 10% on a consistent basis, high unlevered returns on net tangible equity of 10% or more on a consistent basis. If you don't know what any of these terms are, you can check out the link below and where you can get 5 free gifts and that will help you become a better value investor faster, and you'll get definitions and examples of all of these as one of the gifts. These will help you enormously. They're my definitions and how I define things, how I look at things, my value templates, all that. You'll get that as one of the 5 free gifts below if you want to learn more about the kind of specific nuances of those. Why I look for these things is because, frankly, probably fewer than 5% of companies in the world reach these thresholds. 10% most of the time on ROIC, operating margin, unlevered return on net tangible equity, and ROC. 5% higher or higher returns on free cash flow to sales. If a company has all 5 of these, it's extremely rare. If it's sustained over a long time period, 5, 10, 20 years, that's even more rare. So that means that automatically puts them in a higher level of company, in an elite level of company, or a higher quality, which is what we're talking about, company. These things, I also look for these things, not just kind of because it means the company has more profits and cash flow to sustain operations and grow operations and buy other companies and allocate capital better. It's also because if you find these 5 things, it means the company's managers are doing, frankly, an excellent job, and which again is rare. By sustained, I mean, again, 5, 10, 20 years. If it happens 1 year and then it doesn't happen the next year, then it kind of close the next year. Some of the margins are higher than that. I don't consider that as sustained. 5, 10, 20 years. So that is what I determine as quality for investments. Competitive advantages or potential competitive advantages, high margins, high free cash flow, high operating profit production. Also, another way to spot quality specifically is you compare these margins. Sorry, I feel like I got a cat hair or something on my face. That's why I keep itching my face. Is to compare these margins for, let's say you're looking at investment in Disney, or let's go something else. Let's say you're looking at a telecommunications investment in AT&T. You would get these margins in a spreadsheet and compare these margins to Verizon, Sprint, T-Mobile, any other public companies, Telefonica, Vodafone, overseas. You would compare these margins and see which company has the highest margins to see which is the highest quality investment. That if you compare the margins, let's say AT&T, and I have no idea, this is just guess here. In this example, let's say AT&T has 12% margins on all these metrics. Well, most companies in the industry have 7% or 5% or below margins. That would mean, in terms of these metrics, AT&T is the highest quality business. That also means that it's likely valued higher. So you need to kind of intermix quality and value as well, because you can't just buy high quality businesses if they're overvalued all the time, which most of the time they are. My goal, and probably your goal, is to find these high quality businesses when they're either fairly valued or even better when they're undervalued. So you have a higher margin of safety, higher upside potential, and a much higher probability of earning a high return on your investment, or at the very least, not losing money. So these are some of the things I think about when I think about quality in terms of what I deem as a quality investment. And those are some specific things that I look at personally, every investment I look at, and how to compare and see which is XYZ stock I'm looking at the best one, or is ABC stock better if it's in the same industry. Another reason I look at these and I use these metrics is because you can compare these between companies. If you have a diverse portfolio and you don't only invest in telecommunication stocks, let's say you own a food company, um, manufacturer, consulting company, and XYZ other companies. You can compare these margins to other investments in your portfolio to see which is the highest quality investment at that point in time. Now, this changes over time, of course, as new financial reports comes out for each company. So you kind of need to look at these over time, these metrics, and you also need to be wary that some business or some industries have higher margins because of how their business models. A consulting company will almost always have higher margins than a manufacturer, for example, because there's a lot fewer fixed costs, a lot lower dollar amount on an absolute level fixed cost than manufacturer or a consulting company compared to a manufacturer. So you need to be wary of that as well. Um, but these are a lot of the things I think about when it comes to quality. So this is how I define quality: is Warren Buffett type compounders with competitive advantages already intact or potential to um, create them, high margins that, again, probably less than 5% of the companies in the entire world have those kind of margins, based on my kind of anecdotal research over the years, evaluating thousands of companies from all the world. Also, how to compare that to see if you're looking at investment XYZ versus ABC or DEF or whatever. You can compare investments against each other as well. And then when you throw in valuation in there, you can see which one would give you the higher potential return as well when considering these things. Now, it's always not always black and white like this, of course. Some companies will hit every single one of these metrics. Again, that's very rare, and be above them. Some companies will kind of some will be higher, some will be lower. Most will be lower than these metrics. But even if it's higher, let's say it's higher in all metrics and the valuation is not there, you have to kind of weigh these things. And we'll continue talking about how to do that, how I think about that kind of stuff in future videos. But today I just wanted to define how I view quality. So going forward, you kind of have an idea of my mindset and what I'm looking at or what I'm thinking about when we talk about some of these things more in depth. So I hope you enjoyed this video. If you did, if you like this new series, let me know in the comments below. The previous video where I kind of define or do an overview of the qualitative investments or how to evaluate the qualitative side of investments, that link is below. Make sure you like, love, share, comment, and if you're watching us on YouTube, make sure to subscribe and hit the notification bell so you're notified anytime we release a new video, and releasing new videos all the time. If you're watching this on one of the podcasts, thank you so much. And make sure to do the same thing: like, love, share, comment, download, all that kind of stuff. It's greatly appreciated, and it keeps us continuing to grow and help as many people as we possibly can with this value investing, education, and knowledge, and skill set. So again, I hope you enjoyed. Thanks a lot for watching. Have a great day. Talk soon. Bye.